Hope everyone is doing well. Let me just maximize the chart. I use I have a pretty wide screen. It's just kind of one monitor, and I never know whenever I'm using StreamYard. I normally just have the monitor. I normally just connect it to only TradeStation, so it's hard to know what the right setting is. So anyways, overall, pretty interesting day. And on the daily chart, feel free to ask questions, by the way. I'll review them at the end. On the daily chart, we gapped up, and you can see we had a pretty strong breakout follow through here. And we're in a triangle trying to break out to the upside. The obvious targets, at least the next targets, is the February 2nd high. Now, Friday was bad follow through. And by the way, whenever I say yesterday, I mean the prior trading day. So if I say yesterday, I mean Friday. But Friday, we formed a bear bar. So it's disappointment. Some bulls, they bought the close of Thursday, disappointed Friday, and they used today to sell out of longs. So some bulls are long, they get disappointed, they buy more, and they get out break even. With the breakout on Wednesday and Thursday being as big as they are, I suspect probably at least a small second leg up. You should be able to see my screen, and if you cannot, one person says they can't see my screen, but you should be able to. I'm sure others will comment if they can't. Anyways, strong enough breakout, follow through, probably going to get a second leg up. But when we look at this day, when we look at this chart, what do you notice? We have a lot of trading range price action in here, trading range price action in here. So trading ranges are notorious for forming smaller trading ranges within larger trading ranges. So if we look at this chart here, we have an overall very large trading range over the past year. And then we have a smaller range here. And this is kind of like, if you think about it, it's kind of like the open of today. So today, if you can see August the 16th, that is kind of like the August 16th rally. Then we sold off. So the August 16th rally is kind of like the open of the day. Then we had a big sell-off down to the low of today, and then we went sideways. So whenever you get a big rally and a big sell-off, you often go sideways for several bars. If you've heard Al mention in the past, one thing Al mentioned was that the market is probably going to have to get back to, that the market's probably going to have to get back to the August 16th high. Why? because it was reasonable to buy the August 16th high. So traders buy up here and they had no way to avoid a loss on this pullback. Whenever you buy something that's reasonable, a strong breakout in a trading range, there's a 60% chance that the market will get back to the entry price, which is somewhere up here. There's an 80% chance that you can get out break even. So how could you get out break even? There's several ways. You could buy up here, buy more above a bull bar, like maybe here, and you didn't get out break even there. But if you held it long enough, you obviously got out break even anywhere on February 2nd. So 80% chance that the market will allow those traders out break even, which has already happened. They buy up here, they buy anywhere above a reasonable bar, and they're able to avoid a loss. But to me, this is a breakout mode pattern. And I think the odds slightly favor a test of the August 16th high, but we don't know the path. We know it's going to get up here. And the reality is there's probably better than a 60% chance we're going to the August 16th high. The problem is, what do you do if you fall all the way to the March 13th high or even the October lows before we go up there? So don't be fooled. We could easily go all the way down to the August 13th low, which would be the bottom of the past couple years before. Let me just kind of zoom out. So don't be fooled if we go all the way down here before we go all the way back to the August highs. But to me, this breakout looks strong enough, probably a second leg. Will bulls change their opinion about a second leg if the market starts to get 2 or 3 bear bars? Sure. Today's a high one buy, and it's not really that ideal of a signal bar. I just want to check one thing. So the market went 2 ticks below yesterday's low and turned up. And the question is, are bulls going to buy above a doji bar? The doji bar for the stop entry buy above the high one. In other words, today's a high one, which means a stop entry above it will trigger the high one. That lowers the probability. And this is what I was talking about on the weekly chart. The weekly chart, we had a big rally, big sell off. We're going sideways. It was reasonable to buy here. And what we don't know, we know we're going to get up here, but we don't know if we have to fall all the way down here first or even one of these lows first before we get to the August highs. Let me adjust one thing and then I'll start talking about the 5-minute. So here is the 5-minute chart. And if you look at it, the market had a pretty strong rally on the first 2 bars of the day. And one of my concerns is I haven't checked the CME website, but on the chart I have, you can see bar 1 today, the opening tick was the low of the bar. The data could be wrong or the data could be wrong, but either way, typically when the bar 1 is the opening tick of the range, in other words, when bar 1, when the opening tick is the low or the high of bar 1, there's greater than a 90% chance or around a 90% chance that the market will fall below it, even if the bar is a strong bar. Now, is it 90% chance? Is it 85? I don't know. But if you look at enough days, find a day where the open was either the opening tick was, in other words, the open was the high or low of the bar, or the open went one tick below and then rallied. The point is, and the reason for that is most days on the daily chart, the opening tick is not the high or the low of the bar. And it's subtle, but it's enough of a warning, and it increases the chances that we might fall below bar one. Do you need to know that? Not really. It's helpful if you know it, but it's not needed. So bar one, always in long, probably breaking out above this range. And now you have a bull bar on bar two. In general, when you get a bull bar, for the market to become always in long, you typically need a bull bar for the market to be always in long. You need consecutive bull bars with one closing above its high, or at least around its high, and ideally both of them closing on their midpoints. Now, what do you notice about bar one and bar two? When you look to the left, you'll see that we are testing an important area. The bulls got trapped here yesterday, which was last Friday, and the bulls got trapped and they scaled in lower and they never had a chance to get out break even. And now the market's allowing them out break even. Well, even though it was the weekend, the market has memory and the market's going to remember that there were bulls who got trapped. And because of that, that will increase the probability that there may be more sellers up here than buyers. So you can buy the close of one, you can buy the close of two, but it's a little bit problematic. I mentioned about the opening tick being the low of the day, which lowers the probability of the low of bar one being the low of the day for the rest of the day, and 80% chance there's a minor reversal on the open. There's also a 50% chance that there's a major reversal on the open. Therefore, if you get a big bear bar closing on its low, you have to wonder about a second leg trap, leg one, pullback, leg two. And then you get a bear bar closing on its low. So even though when you look at the bar, you see this bear bar and you think, yeah, two big bull bars, probably buyers below three, and there probably are buyers below three. But when you get a bar that almost completely reverses the follow through on the open, you have to ask yourself, where's your stop? Are you going to put it below one, put it below yesterday's or Friday's bar 81? You might. But if this is a trading range, guess where the targets are for the day? The targets are the one low and the low of 81 and possibly the lows down here. So a lot of traders, if they see a bar like three close on its low, they just get out. And it's really important. This is one thing to write down or at least take a mental reminder and revisit later and think about it. In a really, most traders, they view, and I'm pausing to think about the right way to say this. Most traders view wherever they enter, it doesn't matter where they enter. In other words, if they bought the close of one and let's say now the market's here, it's no different than them buying the close of two and the market being here. In other words, your risk, a true trader, most traders see it as your risk being from the current market price to your stop, not your entry price. And I get the logic. It's easy. Plenty of traders, everybody's human. Plenty of traders will. I did that once today. I took a trade and I took part off. And I remember pretty much the market starting to pull back a little. So I just got out for a small profit on the second. And the point I'm making though is it doesn't matter if you bought the opening tick, if the market is now here and you can say this is open profit. It's not really the case. This is your risk, the low of three to the close to wherever your stop is. So a lot of traders see it as not quite 60% chance that we're going to get a measured move up. So they take the loss early and look to buy again. 4 is a weak entry bar for the bears, but it's a bad high one buy for the bulls. It's a bear bar. And that will increase the chances that there might be more sellers above 4 than buyers. Some bulls bought the close of 2, disappointed 3. And what do they do here? They buy the close, they buy more lower, maybe below bull bar. A lot of traders, whenever they buy a bar like 2, they will often buy more at the low of the bull bar rather than the bear bar here. Because typically, when you get a bear bar like this, it often has to fall below the bull bar like bar 2. So they buy here, the 2 close, they buy more at the 2 low, and a lot of them will get out break even. Break even would be around the high of the high 1, bar 4. And then bar 5 went out almost outside down, and it's 3 consecutive bear bars. So now look at the market. We've had 2 bars up and we've had 3 bars down. 2 of the bear bars closing on their lows, 1 closing above its midpoint. This is very dangerous for a bull scaling in. Why? Because the market could easily fall below 1 and go lower before it turns up. If this is a trading range, the reality is the market will probably retest this entry price. So let's just play a game for a second. Let's say you buy here and you just scale in. You scale in below this bull bar. You scale in below maybe here. Look what happened. The market came really close to that level. Why? Because this is where bulls got trapped. Bulls got trapped on the way down from 6. And I'm going to go back to the price action, but I want to point this out. See how this red line is acting as resistance? We get close to it, we sell off, close to it, sell off, close to it, even closer, go above it, and then sell off. That's because this is where traders got trapped. And because of that, the traders that bought, a lot of traders got out. I actually bought during bar 3, scaled in below 2. I took half off at the high of bar 4 here, and I got out when this bar closed on its low. I believe my break even was, I got out somewhere in here. I may have taken a very small loss, but I got out around break even. So anyways, I don't remember if I bought the low of 3 or 2. I know I bought and scaled in, but I took part off and got out pretty quick on the third one because of this bar closing on its low. So anyways, you can see how much this line became resistance. That's why I just wanted to point that out. So 3 consecutive bear bars. If you're trading always in, I would get out below this bar. Too much risk, we sell off to the low of 1. 6, big bear bar. Always in short, probably 4 consecutive bear bars. Strong enough breakout for a second leg down. But you have a big rally and a big sell-off. And one of the important things to remember in a trading range, let me back up. One of the most important things to remember when you get second leg traps, it's very common to get a 2-legged trap that tests the bottom of the breakout point. In other words, the bottom of the second leg, which is bar 1 or bar 81. That is common. Let me just find some examples. Second leg traps are very common. And they're especially common in trading range days. Here's one. So we sold off, pulled back, second leg down, and you can see we tested the high of the second leg and then went sideways. Sell off, pull back, second leg down, or you could say sell off to here, pull back, second leg down. First target, the top of the second leg, and we broke above it here. But you can see, even though we broke above it on this red line, we pulled back to it. So the bears that sold the high here, this red line, and scaled in, they still made money. So always in short, sell the close. Yes. What about 7? It's still sell the close, but you're at the 1 low, and it's probably going to find buyers. Whenever you get a rally like bar 1 and bar 2, that will increase the probability that the market is going to find buyers. In other words, that will increase the probability that this is going to be a trading range day and not a bear trend. So let me just do one thing really quick. I talked about this in the Saturday Q&A session that I did for members of the May trading room. So if you are a subscriber to the trading room, you can log into the website where you get the daily links for the trading room and you can pull the recording. But one of the things I often do is, let me just show this really quick. So just take 1 second. Okay, there we go. I've got it. I'll share it in just a second, but I had to save it on my other computer. I'm going to show you one of the things I try and do every day is build charts off the price action or things I find interesting. So I'll show you here in just a few minutes once it loads one way I build charts. But anyways, always in short on 6, sell the close, yes, but the market may pull back. And then 7 or 8, we got a huge bear bar. This is an emotional bar. And whenever I see a really big bar in a trading range, I'm always concerned that it could be exhaustion. So when I look at this bar, it's a big bar. To me, that's a profit taking bar. The traders that sold the close of 7, put their stop somewhere above here, they made basically all of their risk. They made more than their risk, arguably, because most traders that sell the close of 7 are not going to put their stop all the way up here. So if you sold the close of 7 and you think the day is going to be a trading range, what are you going to do when you see the close of 8? You are obviously going to take profits. And because of that, that increases the chances that the market's going to pull back. So this is an emotional bar. It's arguably a two-legged trap. We sold off to here, we pulled back, and then we sold off again. So we found support here at the 27 low yesterday. We found support here. We found support here around 58 on Friday. And now we're back at that price level. So you know what that means. You know that the market's probably going to find support fairly soon. So this might be more of a buy the close bar than a sell the close bar. And then 9, big bull bar. So anybody that bought in here and scaled in lower made money. Now, what did I warn about? I warned that second leg traps often go sideways. So the traders that bought the one low and bought more lower, what happened? They made money. So if I'm a bear and if I'm a bull and I see a second leg trap, I may get out here, but I know second leg traps generally find support. And the support is somewhere in here. It's the low of 81 on Friday or the low of 1. Why is it either one of those bars? Because you could argue that that is the bottom of the second leg. It's either the 1 low or the 81 low. So if I put a limit order anywhere in here during bar 8, you can see I got filled on the 6, but I got filled on the 7, but I didn't make any money. But if I put a limit order to buy anywhere in here, I clearly made money. I bought more lower. Bulls made money. What about 9? Do you buy the close of 9? 9 is enough of a surprise. It'll probably have a second leg up. The problem with buying the 9 close is it's a big bar, so big risk and bad risk reward. So the risk is big. You buy the close of 9, you put a stop below. 1 times your risk is all the way up here. It's kind of the same thing as selling the close anywhere over here. So you sell the close of 7, stop up here. Your risk reward is bad, and you know that. You know that the market's probably going to pull back soon. So trading range behavior. And one of the things I think is if you're a bull and you bought the 2 close here and you scale in lower, 60% chance the market will get back to the 2 close. There's an 80% chance that these bulls are going to be able to avoid a loss. So they buy here and they buy more above a bull bar. Maybe they buy more here. Some traders would buy a pullback instead. Consecutive bull bars, 9 and 10, good for the bulls. But after the sell off to 8, probably a second leg down likely. Now, if you're a bear and you sold the close of 8, what are you going to do on 9 and 10? You're obviously disappointed. Some bears will say it's a 50% pullback from here to here, and we're above 50%. But either way, probably not going to go straight up, which means the odds are we're probably going to go more sideways here than straight up. Any pullback, though, will probably be bought. If you're a bear and you sold more and sold more, you're going to be sufficiently disappointed, and you probably would rather just exit the trade than continue hoping we get down to the 8 close. And then 11, it's another bull bar. You can see some traders, they sold the close of 9, disappointed 10. They used the pullback on 11 to buy back shorts. 12 is a bear bar, and you can see it's testing back to that range, that red line I showed a couple minutes ago. 13, another inside bar, possible 1 bar final flag, which means there might be more sellers above the 13 high than buyers, but probably buyers below 13. And the reality is, even if we go above 13 and then sell off, there's probably buyers below 13, which means if you're buying up here and you're buying lower and scaling in, you're probably going to make money. But because there's an obvious sell to close target and the bears got trapped, I'm always wondering how deep of a pullback. So here's the low of the range, here's the high of this. We could easily fall all the way down here. So for me, if I'm buying, I'd rather buy lower, but if I'm buying, it's probably better to be able to scale in, and you probably need to stop somewhere down here. Bear bar 14, and then a give up bar on 15. 15 is a little bit of a surprise. It broke strong enough below 13 and 14, probably going to go a little bit lower. And if I'm a bull and I bought the 14 low right here during 15, I'm probably disappointed enough that if I bought here and bought more here and lower, I'm probably going to try and get out around break even. And that's kind of what happened here. Some bulls buy, they buy more lower, they try and get out break even. Let's see if that worked. So you bulls buy here, disappointed. They try and buy more at around the low of the bar or during the bar. And you can see it came back close to break even. Some bulls instead buy the low, scale in here, which is basically the close of the bar. They would scale in 1 times the range of the signal bar down. And you can see they tried to get out break even and they couldn't. Other traders, they bought below the most recent bull bar, 11, scaled in lower, getting out break even. At their first entry, the 11 low with a profit on any scale in entries. Now we have consecutive bear bars. Is it sell to close? It might be, but to me, the problem with selling down here is kind of the same logic as buying up here. You know that there's going to be trapped bears. And if you're a bear and you sold this close and you rode through the pullback on 9, 10, and 11, how are you thinking on 15 and 16? I suspect the bears are disappointed, which means they're probably going to be buying somewhere in here, but we don't know. 4,200, the round number is not far below, so we could easily get below it. And the reality is we could fall all the way to the 8 close before we return up. Then you can see 16 or 17 testing 4,200, and then 18 sold and then reversed up sharply. So 15, good bear bar. 16, it was a bear close, but a tail below. And then 17, another tail, and then 18, an even bigger tail. On a smaller time frame, it's a bear breakout below a bear channel that failed. How is it a bear breakout below a bear channel? Well, if we go to a 1-minute chart and we go to that same price action, you can see breakout parabolic wedge. This was that sell off here. We had a deep pullback and we're testing the lows down here. We had a strong breakout here. This is leg 1. So we had a bear breakout and follow through. That's leg 1. We pulled back. That's leg 2. Then we pulled back and that's leg 3. So you can see we're breaking out below a wedge bottom. And typically, whenever you have a wedge bottom, 75% chance that the breakout will fail and reverse and lead to a couple legs up. Should you look at a 1-minute chart and find this signal bar here so you can maximize your entry and put a stop below? I would not. This is a 1-minute chart. And a lot of these, it's really one thing that's really important to realize is most of the time, right now, we have the benefit of hindsight. And these bars they're not forming as I'm talking. But on a 1-minute chart, in general, on any chart, the market often will reverse halfway during the formation of the signal bar at the halfway point. So what do I mean by that? I mean, if you're looking at a 5-minute chart, the market will often do something drastically different around 2 minutes and 50 seconds. So if you are looking to enter the signal bar, it's often better to wait for 2 minutes and 50 seconds. If you're looking at a 1-minute chart, it's often better to wait for 30 seconds because that is halfway. That means that at best, you have 30 seconds to decide on what to do. And the problem with that is this bar, you don't know if it's going to close on its high until the final probably 2 or 3 seconds of the bar, arguably the final 2 seconds. And that is just not enough time for most traders to process information. So we have a good bar on 18. Probably going to go a little bit higher. So probably buy the close, stop below. Tight bear channel, so the upside may be limited. But for me, I think the market wants to get up here and see if the market can allow the bulls who bought and scaled in out. 19, good bull bar, buy the close, probably going higher. 20, a smaller bar with a bigger tail, testing the highs of 11, 12, and 13. So it's testing resistance. It's still probably buy the close and buy below, but most traders would rather probably buy a pullback at this point. 24, bear bar, but after 3 consecutive bull bars, probably buyers below 24 scaling in lower. Second leg up, 25, but 25 is going above 24, which makes, excuse me, that's 22. 21 is the bear bar, second leg up likely, and it's a pullback from the 3 bar breakout. 22 went above 21, and it's triggering a high one buy above 21. That increases the chances that there might be more sellers up here than buyers. And then 24 or 23, almost outside up, double bottom with the prior bar, big bar, a lot of overlapping bars. Is it buy the close on 2023? I don't know. Probably not. It's always in long, but you're at the top of a trading range, and we could easily break above the range and reverse down. We have a bad signal bar on 17. 18 went outside up, but it broke above the 17 high, which is also the open of the day. That increases the risk that the market has to pull back and reach the signal bar, the a 17 high. 24, disappointment bar, another inside bar. Inside bars are generally lower probabilities, especially in a trading range. An inside bar is a trading range, it's a triangle. But when you get an inside bar within the context of a larger trading range, it damages the case and increases the odds of more uncertainty in sideways trading. 25, possible failed breakout of all the highs to the left over here. And then 26, a bear bar. You can see 25 reached the low of 4 or the low of 5 where the bulls got trapped. So bulls, they buy the 25 low, they buy more lower, and you can see the market broke above it and turned down. 26, bear bar, testing the moving average. Is it buy the close or sell the close? I don't know. It's probably buy the close, but again, I think the risk the bulls face is we could test all the way back down to the open of the day or the high of 17. And then 27 is consecutive bear bars. Strong enough breakout, 26, 27. Probably a second leg down, likely. And then you can see 28 vacuumed down to the high of 17 and the open of the day and then reversed up. So you have some bulls, they buy the 25 low, they buy more lower and scaled in closer to the open of the day. And then the market reversed up sharply. So what happened there? Well, a lot of traders, trading ranges are notorious for vacuum test of support and then reversing and then getting a buy vacuum test of resistance. So everybody knows that the traders that sold here and scaled in are probably going to make money. And that's what they did here. They might break even on their first entry, but they're going to make money. Same thing here. Everybody knows the bulls that buy here and scale in are going to make money. They might break even at their first entry, the low of 25, but they're probably going to make money. And that's why you get these abrupt reversals like 28 or 29. 30, bear, bull bar, closed below its midpoint, so a sign of weakness. Some traders, they sell above 28, sell more above 27, sell more up here. Probably going to go sideways and close this gap. In other words, probably going to go more sideways. And then we got 31, a bull inside bar, possible micro double top and an upside breakout. But so far, breakouts above this area have been failing. And good bar 31, but it may just be a test of the 30 high. So the market rallied on 30 and sold off, and now it's rallying again on 31. So the next bar could be a bear bar, and that's what happened. We can see that on a smaller time frame. So if I go to a 1 minute chart and find 11 o'clock, which is pretty much right here, the market rallied, and you can see this is 10:57. So we need 2 more bars, really 3. That is the close of that 5 minute bar. So it painted a big tail. Then the market rallied, testing these highs, pulled back, and then rallied again, pulled back. So you have a high and then a low, lower high, and then a higher low, lower high, and then a new low. And then we pulled back a little bit, and then bulls gave up. So here you have a bear bar. I still think we're going to close these gaps. Why? Because we're in a trading range. Trading ranges close gaps. 33 bull bar, but it's a pullback. The bulls see a pullback with 32, and they want an upside breakout, but it's a high one buy. 32 is a high one buy after triggering the buy above 33. So there might be more sellers up here. Unless the bulls get a strong upside breakout, probably more sideways. And then you can see 34 broke out to the downside, relieving some of the bears. Some bears sell, scale in, trying to get out, break even. And then 35, a bear breakout, testing all of these lows. So anybody that sold here, scaled in, made money. So 35 is a big bear bar and a little bit of a surprise, probably going to go a little bit lower, but it trapped bulls. There's bulls that bought anywhere in here betting on a second leg, and those bulls are going to scale in. And look what happened on 36. Bulls buy, they buy more lower, and they use 36 to exit. A lot of traders, when they see a bar like 35, they know it's a surprise, which means they know the odds are the market's going to have at least a small second leg down. So if you're a bull and you're looking to buy above a stop entry, when you see 35 close, you have to envision what would it take for you to buy. And if the answer is there's no bull bar that's going to convince me to want to buy, in other words, even if you get a bar like this, you probably wouldn't buy. What happens is as the market goes up, traders sell. They sell to take profits. You've heard Al mention this before in the trading room, but a lot of times, if the signal bar gets too big, like 36, it forces traders to buy in the middle of the range, and therefore there's less buyers and more sellers above. Another inside bar, whenever you get a lot of inside bars, it's a sign of a trading range. Also, whenever you get a lot of bull bars and then sharp reversals, it's another sign of a trading range. So we're getting 3 bars up, reversal, 3 bars up, reversal down, 3 bars down, reversal up, 3 big bars, deep pullback, 3 big bars, deep pullback, 3 bear bars, really 4 bear bars, and then a strong reversal. This is clearly a trading range. 37, 38, consecutive inside bars, and then 39, a bull bar, micro double bottom, may get back up to here. I still think the market's deciding. We had the 18 bar range form in the first 8 bars of the day. Typically, on bar 18, the market has formed either the high or the low of the day, but not both. What that means is the odds favor the market going above 8. What that means is the odds are the market's either going to go above 3 or fall below 9. And you can see we're going sideways in here. Bulls arguably a wedge or double bottom. Low probability buy. Good bar for the bulls, 42, follow through 43, and then another bull bar, 44, but a lot of overlapping bars. Good bar, 42. Good bar 42, but disappointing follow through. And that's what happened on 45. 45, bear breakout. Strong enough surprise 45, probably going to go a little bit lower, but probably not going to go all that much lower. And then you can see 46, we got bad follow through. We tested the lows down here on 18 where traders got trapped, and we got a strong reversal. So, what about buying above a bar like 46? You can, but it's a big bull bar and it's forcing you to buy in the middle of the range. It's basically a triangle. There's many ways to draw it, but we have lows, higher low, high, lower high, lower high, lower high. So the range is contracting. Reasonable buy above 46, stop below. Other traders wait for it to break out. Good follow through 47, and then 48, a bear bar closing on its low. 48, the bears see it as a pullback from the 45 breakout, or really the breakout down to the 46 low. They see a reversal and a pullback. But in the bulls, they see 46 and 47 as strong enough for a second leg up, which means they see 48 as a pullback for a buy below. The bears see a stop entry short. But the reality is, after two bull bars closing on their highs, 46, 47, probably buyers below 48 scaling in lower. And the bears failed to trigger the sell below 48. Bulls, 49.50, consecutive bull bars, 51, another bull bar. It's a micro channel up from the 46 low. But to me, when you look at this, do you say, yeah, it's clearly always in short, always in long, or do you say, I don't know, this looks like a leg in a trading range, and it looks similar to this, or even this or this. So to me, until we break clearly above the range, until we break above 30, break above 25, break above 12, probably in a trading range. 52, bear bar, but a doji. Probably buyers below 52, scaling in lower. 53, strong bear bar. But then 54, bulls bought it. So we had a micro channel, bad, disappointing follow through. Traders bought the close for a scalp. Bull bar on 55. Reasonable to buy above. Probably going to go more sideways here, though. And then 56 consecutive bull bars. Is it an okay buy? It might be. It's middle of a tight trading range. Traders buying, I suspect some bulls will buy above 55 and buy more lower, betting on sideways or an upside breakout. But low probability buy, most traders should wait and see the breakout. 57 triggered below 56. And then it went higher, two legs up. What about buying the close of 58? You can, but again, it's the same problem as buying anywhere up here. You're buying at the high of the range. Second entry short, 59, but not really ideal. For the bears, failed breakout above 43 and 51, and a double top with 30 or anywhere in this area. 60, surprise bar. Possible three legs up to 66, 58, and 60. 60 is enough of a surprise, probably at least a small second leg. But when you see the bar and you look to the left, you notice it's testing the close of 3. Right, another area where bulls got trapped. So good bar on 60, yes. But if 61 is a bear bar closing below its midpoint, certainly on its low, you will have more traders exit below 60. And then 61 is a doji. Some traders, they buy the close of 60, they buy more lower. Other traders, they look at the close of 60 and the bad follow through on the 61, and they say, yeah, that's disappointing enough. I'm going to try and get out at the 60 close. And that's what happened on 62. So the close of 60 is 42.15, and the high of 60 is 42.15. 63, a reversal. So it's a reversal from the two consecutive bear bars. The bulls see 63 as a pullback and trend resumption after 62. Getting close to the bar 2 close. We don't have to get all the way up there, but to me, the bulls are trying to form a measuring gap somewhere in here. And we're basically at that target. They want to move up to here. And then you can see on 64 or 65, we broke above the bar 2 close and we completed the minimum. Give me 2 seconds. So 65 broke above the bar 2 close, which is good for the bulls. And that is an area where we'll probably find profit taking. So bulls, the market rallied, it found sellers, and we pulled back. 66, big bear bar. Surprise breakout, probably at least a small second leg, but the channel up from 57 is tight. And that will limit the amount of traders selling during 66. A lot of the traders that did sold out for a scalp and bulls bought on the way down, which means the rally could be disappointing for anybody that is short, which means we may have to test all the way up here. 67, testing the high of 66, turning down. Second entry short, but to me, probably going to go sideways. Better to wait for more selling pressure. 68, another bear bar, still probably going to go sideways. 69, another bear bar. Is it always in short? It might be, but to me, I think the bears need to do a little bit more. And then 70, we got a doji, and then a bear breakout on 71. And 72 is follow through for the bears. To me, 71 and 72 strong enough for a small second leg down, but we could easily reverse back and test the bar 70 low. Some bulls buy the 70 low, they buy more lower, and they may use any bounce on 72 to exit. But the bears will see the pullback on 72, the tail on 72 as a pullback. Inside bar 73, and we sold off a little bit and then pretty much went sideways in the close. So anybody that bought in this area, the close of 72 or the midpoint, scaled in lower and made money. Okay, I'm going to look through questions and I'm going to also talk about stop entries and limit order trades, as well as buy the close and sell the close. For stop entries, probably okay to buy above 1, but big bar, big risk. Traders sell below 2. They can sell below 4. They can buy above 9, but limited upside. They probably get out below a second entry. Or as 13, as 14 breaks below, as 15 breaks below 14. What about selling below 15? I don't know. That's getting low in the range. If you do sell below 15, a lot of traders will exit as the market starts to reverse up on 18. So if they sell 15 and they see 18 break down and starts to turn up, especially when it gets back to its entry price, the open of 18, a lot of traders will look to exit. Bulls buy above 18. They probably exit somewhere up here, maybe below a bear bar like 26. Bulls, can they buy above 29? They can, but you're trading stop entries in a tight trading range, and that is not ideal. But if you buy above 29, you get out. Really hard to say, maybe below 34. I would not be trading stop entries in here, but if you did, if you're short, you get out above 41, you buy above 41 or 42. But then what do you do up here? You probably get out as 45 turns down. And then if you do, you probably have to buy again above a bar like 46. If you buy above 46, tight bear channel. So you may not have to exit below 53. It's a micro channel, and you could argue that the first reversal down should fail. But if you do, you probably buy again above a bar like 55. It's a second entry after this outside down bar on 54. And pretty hard through here. For me, I would get out a point or two below 65. It's a breakout above the bar 2 close, which was an obvious magnet. And you know there's going to be sellers up here. And then bears, maybe they sell below 68. Not all that clear. They can sell below 71, and then they get out above 78. For limit orders, the entire day was a limit order day. So traders, you can see traders even sold the 1 close or above 1, made money. As far as limit orders go, I think that the easiest limit order trades was probably buying somewhere down here at betting that bears would get trapped, or buying a couple of points like the 21 low or even the low of 20 or 19. Limit order bears selling above, bulls buying below. In general, in a trading range, whenever you see a you see a micro channel, so 8, 9, 10, 11, 12, and then 13. So what is that? 4 bar, 5 bar micro channel. Instead of buying the 13 low, a lot of traders buy a couple points lower. So when they see this kind of environment, instead of buying the 13 low, they buy below the 11 low or the 10 low, and then scaling lower. So in other words, they stagger their target further, or they look at a bar like 11 and they try and buy a measured move down of the bar. So if the range of this bar is 5 points or 4 points, let's say it's 4 points, just to keep it easy. A lot of traders will try and buy at 42.03. They'll try and buy 4 points lower, which would be, in this case, it would be around somewhere down here. But either way, they try and buy a measure move down, they'd buy somewhere down here. So it's pretty much limit order trading for the whole day. Buy the close, sell the close. You can buy the close of 1. You can sell the close of probably 5, definitely 6 or 7. I would not sell the close of 8. You can buy the close of 9 for a scalp, but fairly difficult to do. What about sell the close 15 or 16? I would not. You're low in a trading range, and the bulls are probably going to get a second leg up. Buy the close, probably 19, but you probably scalp out here. And then in here, it's really opposites. Traders buying below 27, buying the 28 close. Traders selling the 30 close, 31 close. Bulls buying the 25, the 35 close. Bulls buying the 45 close. Bears selling above 42, 43, or 44. A lot of traders are not necessarily going to sell 42, but they will sell above bars like 43 or 44. The bulls, some bears that do sell below, they sell the close of 42, and they want the market to sell off instantly. And when they see this, a lot of traders, they sell the close here. They sell more higher. So what are they going to do on disappointment? A lot of traders scalp out. They exit at their original entry, which is the 42 high or the 42 close. And you can see, we don't know if the market went down here and then went up, but either way, let's assume the traders that sold and scaled in, they had a chance to get out, break even, and bulls know that. So bulls buy the 42 close during this bar for a scalp. And you can see, if you bought the 42 close or even the 42 high at 209, the market went up to 1175. So the bulls could easily buy the high of this bar and make 2 points. Now, why would the bulls do that? So why would the bulls buy a retest of the 42 high during 44? Because they know the bears that sold the 42 high scaled in higher or are sufficiently disappointed on 43 that they will look to get out break even, which is what caused a bounce. And then probably buy the close 49, and not really great buy the close, sell the close in here. Sell the close 71, sell the close 72, but second leg down likely. But once you see an inside bar like 73, it increases the risk that it's a final flag and the market will have to retest it here. Let me take a look at some questions. By the way, I'm going to be answering more, and I'm going to be having more and more Q&As in the trading room. I'm going to try and do maybe 1 a week starting out, and then maybe do 2 Q&A sessions a week in the trading room. At least that's what I would like to do if time permits. So that is where I'm going to be able to answer majority of questions. And here, I'm going to try and go in order. Someone asked about trades I took today. Let me think back. I believe I know I bought the close of 1, and I think I scalped out for 5 points. It was either 4 or 5 points, but I bought the close of 1 and scalped out. Now, why did I buy the close of 1 and not go for a measured move of the bar? Because I thought it was a scalp. I didn't think the follow through would be all that ideal. And when I bought the close of 1 and the market pulled back a little, I was also going to scale in. So I was going to buy the close of 1, buy more here, buy more here. But anyways, I bought the close of 1. Market went straight up, so I got out. I bought a pullback. I may have bought right before 3 closed, and then I bought more below 2. I took part off here, and I got out around break even during either at the low of this bar. I can't remember if I took a loss or it was basically break even. It was either break even or, a 2-tick loss, something like that. And I sold the close of this bar for a scalp. I think I sold the close of that bar for a scalp. I don't really remember. I know I sold one of them for a scalp. And I bought the close of what bar is this? I bought the close of 10, and then I bought more. I bought the entry price of 9. So in other words, a lot of times I'll do that. It's a breakout on 9. It got follow through, so it's probably going to go higher. So I bought the close of 10, bought more at the entry price of 9, and scalped out at the high of 10. And I bought on the way as 15 started going down. I bought more, and then I scaled in twice. So I bought here, and I don't remember if I bought here. I bought somewhere around here and somewhere around here. This bar was strong enough. My original target was the low of this bar, 13 or 14. I thought it was a bad stop entry short. So I thought it'd be a magnet. When this bar formed, closed, I moved one order, I believe, to the midpoint of the bar, and I got filled somewhere around there. I took a chance to see if we would get all the way up to here. And eventually, I believe I just got out of the second entry on one of these bars. And I didn't do anything for a little while. Trying to think what the next thing I did. I think my next trade, I bought the close of this bar. So what is this, 56? And then I bought more below 56 or near the 55 low. And then I got out back at my first entry, the 56 close. I did one trade that I thought wasn't that great. I bought as this bar went up, and I believe I scaled in on the pullback. And when this bar closed on its low, I moved my stop a tick or two below the bar. And as this bar went up, I scalped out. And I think I bought the close of 60 and scaled in as 62 started to go down. However, I was worried it was a wedge top, 1, 2, 3. And because it was a trading range day, I ended up just getting out around break even during this bar. In hindsight, it was a little bit of a mistake because it's a breakout of a trading range here. So it's obviously there's a gap, this thin area, and it broke above a resistance level for several hours, broke above it. So arguably the first pullback would fail. But either way, I got out, and the next trade, I sold the close here and scalped out on 72. And the other mistake I made, I bought as I believe I bought as 73, pretty much closed, which wasn't ideal. Or maybe I bought a little above it, and then I scaled in lower and ended up getting out somewhere, maybe 75 close for a loss, or a 76 started to turn down. So I lost a little bit there. And that was pretty much it. Trying to think if there's anything else I did. That was pretty much all I did. Okay, let me look at questions. Does bar 9 make the market always in long, or do bulls need one more bar? It's always in long, but I talked about it. It's probably going to have a deep pullback, so it's not really ideal. If you bought above 46, would you exit below 53? I don't think you have to. So if I bought here, would I exit here? You can. I don't think you have to. It's trying to form a small pullback trend, and it's incredible low. And the odds are we're going to test either the bar 2 close or the bar 8 close. Therefore, it's reasonable to hold. Is there a strategy or accurate milestone you'd recommend when it comes to increasing position size? Here, I don't know. I mean, I think that a lot of traders, I think it varies. It's more about comfort. For me, if I'm trading with $1,000 trading account, I think that is pretty dangerous. You're very much leveraged. So if you just think about the math, if you're trading with $1,000, your risk, if you lose 5 points on a micro, that means your risk is $25. And if you think about that, $25 on $1,000 account is 2.5%. And that is not a lot of risk per micro. So I would be very careful about that. Most traders would use a wider, that's very tricky. For me, I think you need a larger trading account. If you don't have a lot of capital, one of the single-handedly most important thing is to hone your trading craft. You have to, you really have to skill up. And I think that a lot of traders, what they end up doing is they end up burning more capital than they should, just doing dumb things because they don't know any better. So they end up buying here, putting a stop down here, and they get paralyzed here. They just can't get out, and they end up taking this big loss. Or they buy the close. They do something good here. They buy the 8 close. But what they don't realize is after this kind of a sell climax down to 7, or they buy the 9 close. And what they don't realize is after this sell climax down to 8, there's probably going to be a deeper pullback than what they think. Therefore, they buy up here and they get stopped out down here, which this is the area where you should trade small. If you don't have a lot of capital, I would really, really recommend go to Forex for a little bit. The key with trading is to learn and study chart patterns, think about the market, you know, listen to the video course, read the books, listen to the trading room, listen to recordings of Al in the trading room. I'm only saying that because that was my journey and that is what benefited me. But if I didn't have a lot of capital, one thing I would do is I would trade Forex. So I'd look at a 30-minute chart. And here's a 30-minute chart of the dollar yen. I'd see a really big bear bar and I'd say, oh, Brad says those are emotional bars and it might be a second leg trap. So it's second leg traps have deep pullbacks, but usually they go sideways. So instead of selling here, maybe I should wait for a pullback. And some traders, they sell here, they sell more here. And look what happened on the retrust. Traders bought it. We have a rally up to here, but it's fairly tight. So probably buyers below. Several bull bars here, traders buy. They can scale in, they could scalp out here, or they could scale in here and then scalp out. I'm going to go to the, NZD, so New Zealand versus the dollar. We have a bear breakout follow through. Is it sell to close? Might be. And then disappointment here. Lots of bull bars here, so probably buy the close. Tight bull channel, probably going to go higher. Bull breakout, follow through, probably buy the close. And I get it. It took me forever. I really, really wanted to like Forex. And it took me forever to get more and more comfortable with it. But the reason I didn't like it is because I was trying to trade a 5-minute chart and my commission was killing me. I was paying more than 10% per trade trying to scalp out for 10 pips. And what I didn't realize it took me a while because I was being stubborn, was I'd break even on 1 or 2 or 3 trades, and that would be the equivalent of losing 30 or 40% of that trade just in commission. But when I started trading something like a 30-minute chart or a 60-minute chart, and I started going for 20 pip scalps, 30 pip scalps, it made Forex make more sense. Someone says tough day. Yeah, it's trading range day. So you have to buy, you have to do the opposite. Bull bars look to sell, bear bars look to buy. And that's just what happens all day. Someone asked, I'm not gonna, let me just answer this question like this. Trading is a journey, and I learn stuff every day, and I've been watching Al since 2013. So, it's basically been 10 years. And you always, you never quite, I think the key with trading is to really focus on just studying and always learning something. Question: why are bulls trapped one tick below bar 5? Yeah, because if they're buying, if you're buying a breakout bar 1 and 2, 5 is a credible reversal, and the probability becomes much less. So you're buying whenever you have a bad risk reward and your probability, you need high probability. Bad risk reward, you must have high probability, which means your probability has to be greater than 60%. Here, the probability is already less than 60%. By bar 4 and then 5, it's very close to 50-50. And a bear that sells the 5 close can probably put a stop above 5 and have at least 45, maybe 50% chance of getting a target all the way down here. So they have the better math than the bulls. The bulls have large risk. They buy here, their stop is down here, or here. They have a bad risk reward, which means a lot of traders exit below bar 5. Okay, that is all the time I have today. But thank you everyone for watching. And again, you can learn more information by going here, the Brooks Trading course. Also, I'm trying to answer more questions. I will be answering more questions and hosting more Q&As in the trading room. For those of you that are subscribers, be sure and ask your questions there as well, because there will be more time to answer them. All right. Hope everyone enjoyed this, and I will talk to everybody soon.